Okay, welcome back. For this mock exercise, we're going to take a look at P&S company, but this time we're going to actually do the question from the perspective of what if the functional currency happens to be the foreign currency unit. So let's take a look at some technical material. So first of all, when you have a self-sustaining operation, the definition of that is that the subsidiary is financially and operationally independent of the reporting enterprise. So this is when the subsidiary essentially is running, its own operation without any involvement of the parent. So think about the financing, the investing, and the operating activities of the business is really independent of the parent. Exposure to the exchange rate changes is limited to the parent's investment, which AKA would be the shareholder's equity. So if you think about it, if the subsidiary happens to be in Australia and we're from Canada, and given the time zone, given the difference in the customers, the cultural differences, etc., oftentimes a lot of parent company would allow the Australian division to run on its own or run independently on its own. So the method of translation of that type of entity is called the current rate method. And we're going to use that method of choice except if the subsidiary happens to be operating in a highly inflationary environment, then we are forced to use the temporal method of choice. Now, the unit of measure for the self-sustaining operation or when the functional currency is the foreign currency unit is the current rate method. Now, when they say highly inflationary environment, what they're looking for are essentially elements in the environment such as perhaps posting losses for the last 4 to 6 quarters, delisting of the shares from the stock exchange, etc. So that would be areas where double-digit inflation would be a good example where we would consider that highly inflationary. Now, the translation method of choice is, because we're using the foreign currency underlying unit, we're going to translate all assets and liabilities at the current rate method. So it's all assets and liability at the current rate method, the current rate, which is the balance sheet date rate. And the net asset is translated at the historical rate. So it's the shareholder's equity. And this method actually allows us to retain the same ratios and relationship that exist in the local currency and to the actual translated currency. When we did the temporal method, you see that the net asset changes and the individual assets and liabilities, the relationship changes when we're using the temporal method because each element of the balance sheet item, depending on whether we classify them as monetary or non-monetary, will be translated at a different rate. So that's the good part about this method. Now, there is a general item in your textbook that gives you a high-level guide on what exchange rate to use depending on whether you're dealing with a self-sustaining or integrated. And essentially, I'm going to go over these exchanges with you anyway, but it's in your textbook to give you a general guideline. So let's take a look at the question. So the question says that, again, coming back to the question, we're going to use part B, the current rate method. So let's start. So you need to watch the previous video before you watch this one. Okay? So we're going to use the current rate method. And this is the method that we're going to use for this part of the segment of the video. And this is only for self-sustaining. Okay. first we're going to calculate the gain or loss. And what's the next exposure? The net exposure is a net asset, isn't it? That's what we said earlier. So we're going to look at the net asset of January 1st, year 1. Foreign currency, it's been 13,000. Okay, now how did I get that? Well, it's going to be the retained earnings and common shares. Okay, 13,000. Now, what changes the net asset from one year to the other? Well, one of them is profit. And that one we're told was 9,000. Less dividends of 4,000. The net asset is 18,000. Okay? Now, what is the foreign exchange rate? So the net asset is going to be translated at the beginning of the year at the historical rate. Now the profit, we're going to assume the profit is earned average throughout the year. So we're going to use the average rate of 1.16. Dividend is always historical rate, and that happens to be at the date of the balance sheet, so we're going to use 1.22. So the net asset position should be 19,860 Canadian, but because we're holding the net asset when the exchange rate is $1.22, we should have a net asset of 21,960. So we have a foreign exchange gain. Okay? Now, let's think about this for a minute. I have a net asset at the beginning. I build on this net asset by earning profit, giving out dividends, and each of these transactions or elements are translated at a different rate. So by holding on to the net asset, I should have a net asset of 19,860. But because the exchange rate went up to 122, then I now have a gain that I'm going to report. This gain is reported in comprehensive income. It is not in the income statement. It is not reported on the income statement because it's not a transaction income. Remember, it's not an exposure similar to a transaction. It's basically having a net investment position. So that's why it's part of OCI. So let's calculate the next step. Now remember, we're asked to do the consolidated income statement balance sheet, retained earnings, so we need to analyze the acquisition differential analysis. Just like we did under the temporal method. So we got plant and equipment, and this is January 1st. In foreign currency, this was 2,000. And we've got goodwill at 1,000. That was our AD, right? Now, our amortization, okay, is going to be, this one we know was 10 years, that's 200. And we had an impairment of 100. So our December 31st, okay, ending balance of acquisition differential is 1,800 and 900. Now we're going to translate, because these are balance sheet items, we're going to translate an FX rate, and these are all current rate. Right? Because we're going to translate them at the balance sheet, because remember, our net exposure is only the net asset. So all of these assets and liabilities are translated at the current rate. And this one is the dollar amount, the Canadian amount is 2196.1098 to give us 3294. So this is going to be our balance sheet adjustment when we do the consolidated statement. Now, These amortization schedule we're going to need to translate because these amortization, because they're going to affect the income statement, we're going to translate them using the average rates. So we've got, so let's look at the first one. We've got a balance as of January 1st, and that was 3,000, right? Times 1.10 gives us 3,300. This is Canadian dollars, FX, and this is foreign currency. Now, the amortization for the equipment we know was 200. And we're going to use an average rate of 1.16. And goodwill impairment was 100 times 1.16 again. The average is 116. So altogether, the balance, the ending balance of our acquisition differential should be 2,952. But what do we have? We have an ending balance of 2,700. Okay? And that's going to be translated at the current rate. So we have an FX gain of 342. Again, going to comprehensive income. So we need to figure out this gain is going to be added to the previous gain that we just calculated. Okay? And that's what we're going to add to the income statement when we do the consolidated statement. Now, how much of that gain is going to be reflected on the OCI? So let's take a look at this for a minute. So we've got the FX gain on translation of S company, and that was 2,100. Now, 10% of that is of NCI, and then 90. So this is our consolidated balance sheet. And so that 2,100 was from this schedule. That's the 2,100. Now we've got an FX gain on AD, which is the 342. And 10% of that is 34. And this is 308. We're going to use these numbers in a minute. Okay? And of course, 10% is the non-controlling interest, right? NCI. So we needed to do this calculation to really determine the FX gain. So let me recap. So first of all, we needed to calculate the FX gain or loss on translating of having a foreign operation using the current rate method, and net exposure will be the net asset position of the company. We discovered that we had a gain of 2,100. In addition, given the fact that these acquisition differential, the amortization of these ADs happens to be at the average rate, but the end of the year balance are translated at the current rate, we have a further FX gain of 342. The total FX gain for the entire year is 2,442, and we're going to analyze that and split it between non-controlling interest and balance sheet. Now, why do we need this? Because we're going to need this when we're calculating the consolidated net income, which is our next step. So the next step is calculate consolidated net income. And I always like to do that before I do my income statement, because at least I know what my consolidated net income should be. And this is also an important schedule because I'm going to calculate the non-controlling interest. So starting with P company net income, of course, that was $29,392. We subtract dividends. And again, this is the same as the other analysis that we just did under the temporal method. Now, profit of S company. We know that the profit of S company was $9,000, but we know that because the profit is translated at the average rate, okay? Now, we're going to subtract the AD, the acquisition differential amortization, and those we've already done, right? We've calculated those. And they were $232 and $116. That was the amortization of this AD. So we've already calculated those. Okay, now we're going to multiply by 90% to be our proportionate share to give us 34,083. That should be our that should be what our translated income statement should be, right? That should be what our sort of consolidated income statement should be. Now, what is the non-controlling interest? The non-controlling interest income statement is going to be 10% of 10092. Okay? And that would be 1009.20. Okay? Now, the non-controlling interest comprehensive income would include the 1009.2 plus the 10% of what? It would be including the 10% of the, it would be including 10% of the 2442, which is 244. Remember, this is the foreign exchange gain. Right? So we needed to add the 244 here times 2442 is 1253. We're going to need these two numbers when we're doing the income statement because we always have to figure out how much of these income is attributable to the non-controlling interest income statement. Okay? So I want to just highlight those two. And this is calculating the profit of non-controlling interest. Okay, so let's move on. So I want to do the balance sheet. So S company balance sheet translation, and I'm going to need this to calculate, to add to my parent company to do the consolidated balance sheet. Okay, so P&E, property and equipment, foreign currency, we know that was 18,000. Inventory is $711,000, and monetary asset is $17,000. Common shares is $10,000. Retained earnings is $8,000. Now, I just wanted to show you that the FX rate for translating and under the current rate method, these are all multiplied by 122, which is the current rate. Now, common shares is always the historical rate, the date in which those shares were issued. In this case, they were issued at acquisition date, or as far as we're concerned, we're going to use the acquisition date rate as the date of issue. The retained earnings, did we already calculate the retained earnings? Not yet, but I mean, we're going to do that next, the retained earnings calculation. Okay, so I'm going to leave that blank for a minute. I've got OCI, right? Accumulative OCI. How much is that cumulative OCI? It's going to be the $2,100. That's the one that we calculated, right? Bonds payable is $18,000, or $16,000, sorry, and current liability is $12,000. These are multiplied by $1.22, which is the current rate. Now, I need to figure out what this is. How do I do that? Well, I need to calculate the retained earnings. So let's do that down here. So retained earnings, beginning, okay, is 3,000 times 1.10 gives me 3,300. Net income, we know, was 9,000, but we know that's all average rate, right? Now, I need to also do the translation of the income statement, which I'll do after, but I know that net income is going to be it's going to be 10,440 because every item on that income statement is translated at the average rate. Dividends, we know was 4,000. And that is going to be done at the 122, which is the historical rate. I'll put the average, I'll put the H, historical rate. So this is 8860, so we know this is 8860. So that's why I'm able to balance. 8860 is this number here. That's the balance sheet, right? Now, you got to remember one thing. This is the FX gain or loss on the translation in the sub. What this is only on consolidation. This is a really important point to note. So you're probably wondering, why aren't we including the 308? Because this is the translation of S company, and this is only reflected on consolidated financial statement, on preparation of consolidated financial statement. So it's only this part. I want to just make that clear. It's only this part that's reflected. This is going to be on the translation. That's why when we did the balance sheet, and you'll see the income statement, the OCI is only 2,100, but we're going to update that when we consolidate. Okay? Now let's do the income statement next. The income statement is quite easy actually. Sorry, this is the translated income statement of S company. Now, we're going to have sales, 100,000, COG, 59,000, and other expenses. Now, we don't have to split out the depreciation on this because they're all done at average rate anyway, right? So this is foreign currency dollar. FX rate is going to be all 1.16, the average rate. And the Canadian equivalent amount is okay, now we're going to add OCI. And that OCI amount was the 2,100 unrealized gain, FX gain, to give us 12,540, which is the comprehensive income. Okay? Now we're ready to prepare the consolidated income statement. So why don't we do that? Next page. Maybe that might be better. So we're going to do the consolidated now income statement. So I've got sales, parent, plus the sub, COG, parent, plus the sub, now, goodwill impairment. How much is the goodwill impairment? Remember when we did that acquisition differential calculation? The goodwill impairment was 116. Right? 116. Schedule. I'll put the word schedule beside it. Other expenses is parent plus the translated income statement on the sub plus the 232, which is the amortization of the equipment's AD, right? To give us a profit of 440. Net income. Now, we're going to add to that OCI, other comprehensive income, and we know that was 2,100 plus now we need to add the 342, which is these two. 2,442 to give us comprehensive income of 37,534. So the net income is not 440. Sorry, it's 35,092 because it would. That was the total expenses. Okay. Now, we're going to split that between attributable to NCI. Non-controlling interest, we know, was 1,009. Did we calculate that earlier? I thought I did. Okay, so I thought I calculated that at 10%. Let me look. Yeah, it would be 1009.20, right? Okay. And then controlling interest, so P company would be 34,083. Okay? So this is net income attributable to. Now, comprehensive income attributable to, because we need to do this twice, right? NCI is going to be that 1253. That's the 1253 right here. So let me highlight this. It's very important. 1253 is right there. And P company would be the difference between this number less 1253, which is 36,281. So if I do a subtotal of these two, this subtotal should be 35,092, and this subtotal should be 37,534. Okay, so I just want to highlight these two and this one. This one is this one here, and this is this one here. Okay, now I need to do the statement of retained earnings. It's consolidated retained earnings statement. Again, balance, January 1st, it would only be P company. Net income, it would be 34,083, and that would have been from the previous schedule. Okay, and then dividends of 10,000 to give me balanced at December 31st, which is, the dividends would be 22,000. This is P company only. Okay, and this is from the schedule, right? Okay, now, before I do the balance sheet, I need to calculate the NCI balance sheet. That's my next step, okay? So again, just like I did the other one, let's figure out the S company's shareholders' equity. You got common share of 10,000 times 1.10, the historical rate, plus the retained earnings of the parent, of the sub, which is 3300 plus the income minus the dividends, same calculation that we did. Okay, now we need to also look at the unamortized 80. And what was that amount? It was 3,294. And the cumulative FX gain or loss from translation, which is this 2,100. That gives me 25,254 times 10% to give me 2,525. That's my translation balance sheet. So now I'm going to do the balance sheet statement. I'm going to need that number to calculate a non-controlling interest balance sheet. Okay, so I'll do that next. And that's my final statement. So first, property and equipment. I got 60,000, that's the parent, plus the subs, translated balance sheet, right? Plus the AD of 2196. That was the amortization differential of AD 2196. Goodwill, that came from our AD. Inventory, 30,000 parent plus the subs translated Canadian equivalent. And monetary assets. That's 180,996. Common shares, we know that was 30. This is only parent. Retained earnings, we just did that statement, didn't we? It was 40. The retained earnings statement was 46,083 from another schedule. Accumulated OCI or FX adjustment in OCI is 2198, and that came from our analysis. It was these two, right? The sum of these two. And that was our 90%. That's our 90%, right? NCI, we just did that. Schedule, I'll put the word schedule here. Bonds payable is 40, parent plus S companies. And current liability is parent plus S company. That gives us 180,966. Okay? Now, one last thing before we finish this question. What was the main process? The main process, so this is kind of an overall, what did we do? The steps, overall steps. First, we calculated the FX gain or loss. Right? We calculated FX gain or loss. Actually, before that, we should really determine the translation method. That's really the first step, isn't it? And then, once you determine the translation method, we calculate the FX gain or loss. Then the third is we translated the subs financial statement as follows. So we translated income statement first, statement of shareholders' equity, of retained earnings. Then we did the balance sheet. Okay, we didn't do cash flow in this question because presumably you would have had to translate it and prepare the consolidated statement before you did the cash flow statement anyway. Once we've done that, Then the step 4 is we analyze the acquisition differential, call it the AD analysis. Then we did the amortization of AD. Now remember, that was a very complex because a further gain or loss would have been calculated. So this could result in a further FX gain or loss. So we saw that in both the temporal method and the current rate method. So once we've done that, normally what we do is we calculate the consolidated net income, and that allowed us to determine the NCI income statement, which we need. Then step 7 then says we need to prepare the consolidated income statement in good form. Eight, we calculate the NCI balance sheet. And again, this incorporates the FX gain or loss, not just on the translation of the sub, but also the amortization of AD. And the final step is prepare the consolidated balance sheet in good form. Actually, I've forgotten the actual, sorry, this should be a 7A here, is prepare the consolidated income statement of retained earnings, right, in good form. So that should be like really in between those two steps. Okay, so this question, P&S company, was a much more involved question because it incorporates not just translation of a foreign operation, but also the impact on how, and the impact on the consolidation process, particularly once you've translated the foreign operation. So these are the overall steps. So it's handy to know what these overall steps are. So the first step is determine the translation method. Step 2, calculate the FX gain and loss on the foreign entity. Step 3, translate the sub's financial statement as follows. First, you need to translate the income statement and the statement of retained earnings in the balance sheet. Then you analyze the acquisition differential. So if the question really was only translating the foreign operation, then you only need to do step 1, 2, and 3. But when you're dealing with the consolidation process on top of that, then you need the rest of the step. You need to analyze the acquisition differential. We've done this many times. We've also amortized the acquisition differential, but in this case, because you have a foreign entity, another further exchange gain and loss may be calculated at this point. Then you calculate the consolidated net income. That we need because we need the non-controlling interest net income statement. Then we prepare the consolidated income statement in good format, make sure the two balances are equal. Then you prepare a consolidated retained earnings in good form. Then we calculate the non-controlling interest balance sheet. Then we prepare the consolidated balance sheet in good form. Okay, so those are essentially the 10 steps. Thank you.